Howdy, everybody. Thomas Talbert with Prime Properties here and with the Austin Market Pulse podcast, which we officially had just named. I've had a couple of these podcasts, Peter, that you had been on that I haven't had a name, but I just finally came up with one. So I had a partner help me with that one. But Austin, welcome to the AMP podcast. I have my guest here in client for years, for me and Prime Properties in general, Peter Meisen, who we have managed his homes for a number of years at this point. And I thought it'd be great to hear a little bit more about his story and his real estate expertise, because quite honestly, in terms of just overall experience, he outdates me by miles. And so I figured it was good to learn a little something from the expert here. Peter, how are you doing?
Good. Thanks for having me.
Well, of course, Peter, we will get started with learning a little bit more about you. Tell us where you're from, what you do, how you got started in real estate, and then I'll ask you more specifically how you got into Austin.
I'm in San Diego. I'm a remote owner when it comes to Austin. We started here, my wife and I, years and years ago. Both of us were doing nonprofit work, and we looked at each other and said, we don't have a retirement plan. We both had a little bit of experience in real estate. Hers was good, mine wasn't. So we took both of those lessons and we started buying a single family home for our daughter. And she was going to college, and that had tenants or co-tenants with her other college roommates. And that worked out well. We refied it, and then we bought another one. And ultimately that became the model. And I can recommend that to many people along the way. You find something that works for you as a good single family home rental. We always bought a fixer at that point in time. It was something that sometimes it only needed paint and landscape. We never buy anything that had a foundation problem or anything that a cracked slab. We have those in San Diego. So we didn't want to take on that kind of challenge, but we could paint, we could do landscape. And this is a point in time where I didn't even own a hammer, but I got a toolkit, a box, and started to learn my way around Home Depot. And so we did well on that. We actually still own that house 35 years later. It's been a phenomenal rental for us. We added what is now called an ADU, an accessory dwelling unit. It's a granny flat, essentially, in the back. So it's got a house in front and a single bedroom in the back. In San Diego, that rents now, total rent for those two is $5,000. And it's a phenomenal cash flow for us. So that one, when you have a cash flow generator like that, you keep it. And so you keep fixing it up and make sure the tenants are happy. So we did that a few times. And what happened in our market around the end of the 90s was the values started to go over 200,000, which sounds ridiculous when you say that now, right?
Not now, oh my goodness.
And that was an important number for us back then, because one of our criteria, Thomas, was we would only buy houses that would pay for themselves. The rent had to cover PITI. So bottom line, we were not going to do any negative cash flow. That was my lesson from previous incarnation, that if you get in trouble and you have negative cash flow every month, that's an alligator that will just eat you up. And ultimately, the bank took my 4 units back, and I licked my wounds. But it was a good lesson. That's a good lesson to have when you're young. You can come back from it. That's always one of the key criteria was there enough income from the rent to cover the key expenses, PITI, and would we live in it if we had to? That was the other criteria. So let's say everything went to hell in a handbasket, and whatever that means, and we had to live in that house, we would be comfortable living in that house. That was an important choice for us. So that determines sometimes the quality of the neighborhood, whether it had a little bit of a view or not, or if it was there's some things that eliminate a house for us. And if it could be it's just too darn noisy because of a neighboring school, maybe, and you have somebody playing baseball all the time that would drive you crazy. Or if it's a really busy street, we would never buy a house on a really busy street as a rental, because ultimately we have to rent that house to somebody. and they're going to not want to be on a real busy street either. We always wanted to find a house that we would live in if we had to, because we would then get a tenant that was like ourselves at some level, usually somebody who's moved up from the apartment level and now wants to live in a single family home, because most people aspire to that. Even if they can't own it, they want to live in that type of arrangement here in San Diego. And so that did us well.
That's good. And did you well? And so you guys figured out your model. And then in San Diego, how did you guys scale that out? If you bought single family homes that you would live in that covered your PITI, how did you scale that out in San Diego? And then how did you pick up that model and try and bring it into Austin?
We had several, and there was a situation where I had a good opportunity to sell a particular property where it had gone up a lot in a short period of time after we fixed it up. And we were looking around, and like I said, the values had now bumped above 200,000 in San Diego. So this rent versus PITI number wasn't playing out. And we took the gain from this house, I'll call it the net from this house, and we started to go, where else in the country would we purchase if we had an opportunity? And I had been in Austin before several times. I love the city. It was a great place for many reasons. The river going through town, the music downtown, of course, had a great university. It was a headquarters or government town. So it had the features of having enough people, which one of my instructors way back said, always find a city that has at least 1 million people in it, because that means there's going to be enough of an economy to make sure you have people that are looking for houses to live in. And he also said, if you can get a town that has a college and a corporate town and or a government town, you have people that get paid every single month so that they can pay your rent every single month. So that was a key criteria, right? I'd been to Austin, liked it, looked at Zillow really wasn't around then, looked at realtor.com, and you could get a 4-bedroom, 2-bath house back then for $150. So we took our single family home that we had in San Diego, and we were now doing a 1031 exchange, and we took that gain and bought 3 single family homes in Texas. There's 3, 4, 2-bedroom, 2-bath. I would live in any one of those. I think we still own 2 of them. We leveraged another one into a couple others, but we loved the 4-bedroom, 2-bath model. We always want a second bathroom, because if one bathroom goes out for whatever reason, a toilet gets clogged, there's another bathroom for the tenants to be there to use. And these were beautiful middle-class homes, in most of them in North Austin area, a little bit further north. And so that worked well for us. And that's when we started saying, we obviously have to have a manager now. We can't manage it I manage all the rentals we have here in San Diego, but we needed one. So I did a pretty deep dive into the property managers in Austin at the time. Your predecessor, John Pendleton, had a very reputable firm and management company there, and we just did rentals. I didn't want to find a company that was doing real estate brokerage and commercial leasing, and I just wanted a company that was going to manage the houses and had a connection to the board of realtors, that had a great reviews on all the different places you can check reviews. I called existing owners like myself and got referrals from them to make sure they gave a clean bill of health. And so that's where we started with Prime Properties. And that was, I want to say 25 years ago now, was when we started with Prime, and have been with you guys ever since.
A key distinction I want to make sure I point out here is that Peter inherited me. He picked John, but he inherited me, and you've stayed this long, so I imagine that I'm not upsetting you too much.
The transition was always a question mark, because you're getting new people, you're getting a whole new process, and it's turned out fine. So we were anxious in the transition. We wanted to make sure the people were good. The reporting and the management was going to be the same or better. Some of the staff that John had stayed. And the critical thing when you have a manager is, are they going to take good care of the tenants? That's the important thing for me, is I really love our tenants. I want them to be happy. I want them to stay for years and years as a tenant. We had one in San Diego that was in our home there for 25 years. They've paid the mortgage on that house, if you think about it, over the time period. I know we've had a few tenants in Austin that have been there for over a decade. And I am thrilled that when I get out to Austin, which is usually once every 3 or 4 years, I go visit. I want to go meet them. I want to go ask them how they're doing. If there's any issues with the property that we need to take care of, I make a list and I give it to you.
Yeah.
But I give that list to you and the bear, and I say, would you please go take care of these issues? Because if we do, and if a tenant says, here's what's bugging me, and we go take care of those within the next month, they're happy, right?
Happy tenants staying. That's exactly right.
That's it. So that's what I've always tried to do is go visit them. Not often. I get out to Austin again, like I said, every 3 or 4 years. But I do make it a point to go visit each of those tenants and ask them anything about the house that they're not happy with. And that's the punch list that I give to Bear. And I say, can you please take care of this right away? And so that's always worked out well. Because I just know if we can, and I know we've talked about rental rates even recently, Thomas, we're lowering the rent on one of our recurring tenants now because the market's come down. And I know tenants are very price conscious, that they watch the media and they know what's going on, just like you and I do. So if I try to maintain my same rent in a market that's now getting soft, there's a chance they may go, I'm going down the street. I can get the same house for less rent down the street. But if I lower that rent just a little bit, they're going to go, man, that's a good offer, and hopefully that will get them to stay.
On the goodwill that gives the tenant, because $50 a month, let's say, is $600 annually. And that is, to a tenant, even if that's not a whole lot of money, the idea is, wow, like Peter values me and his home, and I really appreciate that. But he preemptively gave me this. I didn't have to ask for it. There's a lot of goodwill you build with doing that without them having to ask.
That's probably what we're going to do this year. I pay attention to what's going on in Austin. I know the values every house that we own is down in value by 20% from the peak. Everybody knows that. Rents are soft for sure. I just looked at Zillow before we went on. There are hundreds and hundreds of homes available right now in the 3-bedroom, 2-bath market. So there's competition. And in that marketplace, there are other owners just like me that want to rent their place. So we will look at that neighborhood. We will look at the condition of those other homes. And Thomas, I'm probably one of the more, I don't know, aggressive owners that say, I want to be involved in this process. I want to be a slight under the market by $50 to $100 compared to all the other homes that are available. Because every tenant that I've ever met is price conscious. They want a nice house, but they want to get the best deal they possibly can. So I want them to come to our house first, look at it first, have it look beautiful when they walk through. And I only need one coming for each house, but I don't want to be the first one they look at. Hopefully the first one they choose.
Yeah. And I think that's a really smart thing to consider, because what we get a lot of, certainly with new owners, is, let's overshoot the price point and then negotiate with them on the back end. The problem with that is that certainly with the digital age that we live in now, people are making their decision, for the most part, they're making 70% of their decision while they're sitting on their couch. And so if you don't match their price point, they're not even going to look at you. They're going to go consider something else. Even though you may have been willing to come down to that price point, you are not going to get the at-bat with those tenants unless you're advertising that price point. And that's been tough, certainly in this market, because Peter, I'm sure you're well aware, like you said, you're well aware of the stats. We're getting a lot of owners who bought their homes at the peak of the market, and now the market softened and their rent even is not covering their mortgage. And they are saying, but I need $2,800. And it's tough to stare them in the eyes and go, I can't get $2,800 for you. I'm sorry. And that's a tough reality for a lot of folks to come to grips with. And that's good that you've had that sort of thesis and managing as many units as you do personally over there in San Diego. I'd have to imagine that's a lesson that you learned pretty early on. How many units do you own over there in San Diego? I know you have 5 with us and they're all single family, but you've got a bigger
Several. We have several. We have several here as well.
Yes, you have several there. I know that you have a few multifamily, or maybe one small garden style multifamily. You said a few other single families.
Never did. We stayed in the what we're comfortable with in the single family marketplace. Recently, we talked about a 1031 exchange that we did on a property in San Diego that it had lost all its depreciation value. We owned it for 30 years, so we're not getting any depreciation anymore. It had lots of equity because we paid it off, and it was just time to it was getting a little long in the tooth. So we exchanged that one, and for the first time went into these things called DST 1031. It's a marketplace where you can still do a 1031 exchange, but become totally passive. So there's a number of, it's like a REIT, if you think about it. And there are these companies and managers, sponsors that manage these large complexes, 400 or 500 units. And we ended up with 3 different properties in Dallas area, Ashland, Oregon, Ashland, North Carolina, Asheville, North Carolina, and in Florida.
Those are really interesting products that have come online recently. There was a networking group that I was a part of that had a guy that did DSTs, and the DST they were pushing that month that I was meeting with him was the Academy Sports and Outdoors headquarters was doing a sale leaseback so that they could free up some equity to go do something else. But the DST was to hold Academy Sports and Outdoors HQ, and the tenant was going to be Academy. So they're these really big transactions and things that you get to take part of. And it's really cool. I haven't done a DST myself, but it's a really neat product that I really think is going to benefit a lot of people.
You can look them up online if you look up just DST 1031, and there are dozens of REITs that are available in that marketplace. You can buy directly into them. We did it as an exchange into it. And some of them are distribution warehouses. Some of them are dollar stores. Some of them are senior facilities, but they're all aggregated funds from people like myself. They need 40, 60, $100 million in their pool to actually fund these purchases. And so they aggregate all of these investors like myself. So we get a little tiny piece of a bigger pool. We just stayed in the residential market again. We only stayed with properties that are not houses, but single apartments, big apartment complexes, because I always know if you adjust the rent, you can find a tenant. Some of these properties were one big distribution warehouse. And even though I had the idea of having a FedEx as a user or Amex not Amex, Amazon as a user, if for some reason that particular property goes vacant for whatever reason, it might sit vacant for a long time. So I know we have 95% occupancy in each one of these complexes. So we've been happy with the DST marketplace so far. So we'll probably do more of that as we want to have less hands-on, even with you. You're a very hands-on manager, of course. When we want to move out of that, we'll probably get into that another DST.
No, and it seems like a no-brainer because you get all the tax advantages, but none of the managerial headache. And I really do think people with a lot of equity in their home, such as yourself, that's going to be really attractive. And correct me if I'm wrong, but if I remember correctly, it's the drawback of the DST is that you locked up your money for 36 months or something like that.
Well, they usually say 7 to 10 years is the time frame for when these properties will sell and there will be a liquidation event, where at which point in time you can take your money or you can do it again. So you lose the control of any choice when you're going to get out. You can't sell your shares to anybody else. How they sell it out, there's no tenants, no toilets, no trash, no terrible auditors. I think those are you get out of managing any of those issues and you have a manager that takes care of all of it. You get a check every month, just delivered into your account. and a statement at the end of the year for the tax purposes. So it's a very passive thing. But even with you, Thomas, I'm a passive owner at this point in time. I don't manage anything. You do all the management, you do all the repairs, and you send a statement every month with everything that came in and every expense that goes out that we can, and sometimes we sit down and we cover it. So I understand how that statement worked. But that's really a passive management system for us here in San Diego. It's you're our manager there.
That's obviously what we aim to be able to give to our clients is allow us to get our hands dirty. And when you have a question, please call. Doubling down on that DST route, as someone who has a fair amount of equity in these homes, I'm just talking about the portfolio that you have here in Austin. I'm assuming you do. With this softened market that you're able to weather a little bit better than most because you have such a great equity position in your home, what does this slower market signify to you of what you need to do as a real estate investor and trying to be a good steward of your money in your equity position? What does that push you to explore other opportunities like a DST, for example? Is that signaling to you maybe this would be a good time to buy another rental property, do a 1031 exchange, which you have done in the past? Where is your headspace at while being in this sort of down economy that you're participating in several markets?
And everybody's participating in a down economy, so we're not the only one. When you're looking at your equity has gone down, you don't have as much, but you can now buy a cheaper property if you're going to, or exchange into a cheaper property that maybe has gone down in value as well. So you can't play both sides of this game. If you've lost some equity, everybody else has it at the same time as well. What I sorry about our dog, but you can just include that into that.
There you go.
What we do is we look at our return on our equity. We can do a pretty good analysis from both Zillow and Realtor and say, what's the equity that we have in a property right now? We look at the rental income, expenses, and ultimately our net income numbered over our equity and say, what's our return on our equity? And in some cases, it's gotten down to 2 or 3% when you have a full equity in house and no loan. So you definitely start to say, where can I get a better return on that money? And so we are sometimes looking at that right now because that's occurred. I don't have a decision to make. I don't have to make a decision. I'm not in a position where, like your owner that just bought a house this last year and is underwater already in terms of their obligation. I'm fortunate that I don't have that issue, but we certainly want to maximize the return on that money. We're not enamored with some of the other, shiny objects that people are selling out there. We've not gotten into precious metals. We've not gotten into, some of the,
and all that. Yeah.
What we want to own something that has cash flow. That's always been our mantra, because when you get to my age, my wife's age, what you want to do is you want to have cash flow every month so that you can pay the underlying bills that you still do owe and have enough excess so you can play a little bit, travel a little bit, take the grandkids out and spend some money on them. That's been our goal, is to make sure we have plenty of cash flow and so that we can have the fun that we want to do at this point in time.
No, and I think that's an incredibly useful thought process, because it really does depend. If you were younger, maybe it's all right, lever up and go try and find some more equity that we can gain over a few years in another spot. Does that make you think, hey, in terms of my equity position and wanting that cash flow, does that mean paying off notes that you have on certain properties, or does it mean selling the house and buying something all cash so that from day one you don't have that outstanding debt that you might have if you were trying to be real aggressive?
We never buy all cash because you make money when you have a little bit of leverage and the value of the property goes up. So you make your real money in the purchase, right?
You always make money when you buy. Always.
I was looking at the market in and around Austin right now, I shake my head and I go, if I were a buyer right now, there are properties under 200, that 3-bedroom, 2-bath properties that are under $200,000.
Yeah.
And I go, I would be out there knocking on doors. I'd be calling. That's where I would be starting. I'd be looking for the dog on the block. And I think everybody kind of understand what that is. It's the one that looks bad, but still has good bones, so that you can go in and with not a lot of extra money, paint, landscape, maybe a little bit of fix up, might be $10,000, $20,000 that you'll have to invest. But you put in, again, you're going to have to usually as an investor put in 30% down. That's always what we had to do. So that's the challenge for a lot of people getting started. So you may have to find a partner or somebody that has that down payment money. But you buy a $200,000 house, you now have a $140,000 loan, PITI, even in Texas, that will now start to cash flow. And the rent's probably $1,500, $1,800 for a property like that. So and if it pays for itself, you can sleep at night. So for me, that was the criteria. I didn't want to have to wake up worrying where I was going to be able to pay my mortgage every month. So also like the sleep factor. If I were a buyer right now, and I'm not, but I would send people out on a list of everything that's under $200,000, because here's what I saw in San Diego. That market kept going back up. There will be a time when all of those properties are gone in Texas and in the Austin area, and they're now all above 200. It's a price point. It was a price barrier that I just saw occur here in our own marketplace. So sometime in the future, everything under 200 will be gone. People will buy now and in a pretty short period of time gain $20, $30, $40, $50,000 in equity. As those things increase in value, we're going to have a decent sleep factor because you're going to get a renter that's going to pay your PITI plus your prime properties management, and you start to build your portfolio. And then what we did is that once that thing increased in value enough, we wanted to go do it again. So it was a repeat. We took a second trust deed. We found people that were willing to give us hard money on a second trust deed on that house, on that first one, and used that as the down payment for the next. And then we did it again, and down payment for the next. And finally, there was enough to do I'll call it a global refinance. And we got rid of all the second trust deeds and put them at a lower interest rate with first trust deeds. Along the way, you really need a good mortgage banker, somebody that has your interest at heart, somebody that knows the marketplace. The craziest thing, Thomas, that happened to us, and we have a mortgage banker in our family, so that has obviously our interest in mind and knows our situation. And we were building this ADU that I mentioned a little earlier. We said, we need a construction loan. And he said, what are you going to do? How much do you need? And he ultimately found a product for us that was a 40-year loan. Now, I'm not going to share my
40 years. Holy cow.
40-year loan, interest only for 10 years. So the principal hasn't changed since we took this loan out. All we're doing is we're paying interest on this, and we got enough out of it to pay off some of these mortgages that we had in Texas. So those the ones that we have there, sometimes there's no money owed at all on some of those. So that's pretty nice. And it increased our cash flow, which is at our age, that's what we wanted to do, was to pay off some underlying notes, increase our cash flow. And in 10 years, probably, I am sure we will have decided to move those properties and exchange them into something different.
Yeah, that makes total sense. I want to circle back on your dog on the block theory that you mentioned, and you're spot on with that's so important to do for a multitude of reasons. One is the arbitrage opportunity in the equity of the home. Commercial assets sell. So when I say commercial assets, I'm talking about the REITs, the things that the REITs that are buying, that those DSTs are buying that we were mentioning earlier. They're buying those assets, and those assets are valued based on cash flow, how much money those assets are producing every single year. In single family homes, the reason you want to go for dogs is because that is not that is not how single family homes are sold, or the value of them is calculated. They are calculated based on your neighbors. What did your neighbors sell for? And so if you can buy the dog and take the bonus depreciation of what your neighbors are doing around you, just by fixing up the dog, you have realized a bunch of equity. And then, of course, with the cash flow, you're able to have the renter pay off any expenses that you had and still be able to hold that asset at a very reasonable price. And you're land banking at that point. Where did the dog theory, the finding the dog theory, come along for you in your real estate journey? When did that one click?
Gosh, I don't know. I've had several, I'll call them real estate trainers or gurus along the way. Some of them are very well known. Their names are known. And I don't think that's a unique moniker for purchasing. What's the smart thing about that too is there's less competition. When you're a buyer, I don't want to have 10 other people interested in that same property, because if you go back to the days of the pandemic, boy, you had 10 and 20 people going after properties, which is why it got so inflated. People would buy things they didn't even go look at, right? I never want to be in that position as a buyer. I want to be the only person that seller and that real estate person is talking to, because now I have potential for negotiation power. When we put in an offer, what I want to do is go into escrow. And I don't know if it's exactly the same process in Texas, but we go into escrow here, and then we have 2 weeks to do our property inspection. And we basically wanted them to go in there with a screwdriver and start punching walls and testing pipes and seeing what's wrong. And usually with a dog property, there's something wrong. It's evident just by looking at it that it's less in value.
I don't know what's wrong, but I know there's something wrong.
Yeah. And so we have the potential to go back and make an amendment or a counter offer that says we would like these concessions before close of escrow because of this and this. And again, if we're the only person that they're looking at that has a solid offer on the table, they may take it.
No, and I think they call that the blue ocean theory. There's always people fishing off the pier, and that's where the most competition is. But you want to get out into the blue ocean and where there's no one else around for thousands of miles. And that's where you're going to be able to catch the bigger fish, get the better deals, so to speak. I've heard that taught too. That's really neat.
Yeah. Yeah. And that's always worked for us. Anytime I got into, I'll call it the auction or the buyer's frenzy, I walked away. I didn't need to participate in that.
No, and that's really smart. And for people to know that it's a numbers game. And I just I interviewed a wholesaler on a prior podcast, and he was talking about how in their business, basically they walk around looking at dogs for a living, and how they make their initial offer is, generally speaking, 70% of the value of the property minus the repairs. So 70% minus roof, minus HVAC, minus the water heater, whatever they feel that they need to replace, is what they go along and do. And they do that to 1,000 different properties before they get to that someone takes them up on that offer. But that's you only need to.
You only need to. And that's the point, is you're not embarrassing yourself, or you're not doing any disservice to anybody. You just need to find something that will work for you and the numbers, because ultimately long term, this is something you got to pay for every single month. PITI comes due every single month. We were never flip and fix and flip. That was never our game, because boy, you get into fix and flip, there's a lot of taxes that go along with every time you flip the property. A lot of taxes, state and federal. So we never wanted to be in that particular marketplace. Some people make it work. People like you just mentioned, when they go out there and they're looking at, they immediately go, can I get my return on a fix and flip out of that, and then go do it again and again. We are looking for something that we're happy with long term. Again, I gave you the criteria. It may not be in the perfect neighborhood. When I just opened up Zillow again, they're spread out. all over the Austin, as well as there's a ton of them right now in San Antonio. If you want to be in that marketplace, there's a lot of 3.2s under 200,000. So plenty of product out there. And if you just go online and start, we did a square footage analysis of homes when we first look at the ones that we purchased, because we know that that's one of the comps that an appraiser will use to value a property is what's the cost per square foot? What's the comparable to the 4-bedroom that's just next door, that's just down the street that's sold? We would look for as much square footage as we possibly could, the dog on the block again, in a decent neighborhood. And that's how we started to focus where we were purchasing. And gosh, we love the Wells Branch area. We love up in Millwood because it's right next to the new Apple campus up there. So there's just lots and lots of good people making really good money that can be your tenant. So that's what makes a big difference.
And that's great. And you mentioned the 4.2.5. The investor standard for years has been the 3.2. And I think you'll hear a lot of people say that. You focused for 4.2.5 specifically in the Austin market. I've got my reason why that's a smart idea, but I want to hear yours. What brought you down to the 4.2.5 market?
Okay. Because when we started, like I said, we could get a 4.2 for 150. And why not? Why not get the extra bedroom or the home office or for the workout room or whatever extra room that people want in a home? And especially now, you have a lot of people working from home and a lot of people that like that extra space. So it made sense for us to get a little bit more square footage, to get that extra bedroom, to get that extra value by going with the 4.2.
No, and it was a very smart idea. And looking back on it, hindsight being 2020, I think you couldn't have made a better decision.
I'd be happy to go with 3.2s right now. By the way, with these, when I was looking at Zillow, I was just putting in 3.2 as a marketplace, and again, there's lots. If I were selling something right now, if I was selling something right now in Austin and wanting to go replace it with 2 or 3 more homes, that's what I'd be doing. I'd take our equity and I'd go put 30% down on several houses that I just described. We'd have to go dig for a while. And when you're doing an exchange, you got some criteria. You got to choose in 45 days and close in 90. So there's some tight numbers that you have to meet. But that's what I'd be doing if I was doing an exchange right now in the Austin area.
No, I don't doubt it. And that 4.2.5, it's interesting, a matter of focus. 3.2.5 is a good market standard for any market because every market has 3.2s. But knowing where your asset stands in relation to that 3.2 number is important. And for example, someone with a 2.2 or a 2.1, when extrapolating what 3.2s are doing, to know where you fall on either side of that, standard 3.2 market is an important thing to know, and also know what factors may affect that. For example, Austin has been a place for people to move that have families. If they have more than 2 kids, which a lot of people do, that extra bedroom looks really nice, and you're able to get a little bit more of a premium on your rent price because of it. And from a construction standpoint, it's almost the exact same square footage. The builder almost doesn't care. They get, certainly if they're in a pinch, and we're seeing a lot of that right now. I could go on and on about that, about buying from builders at this moment in time, but I won't bore you with it. But I want to wrap up this meeting, Peter, and thank you so much for your time, with your personal analysis on what to expect in the Austin market this year or the next 3 years. You've done the research and you very clearly read on the subject. What is your prediction for Austin, Texas going into 2026? And what do you see in 2030, just to pick a round date?
I wish I knew. When you saw the value of your house go from 550 at the peak, whatever it was, I think it was in June or something of 2022, to a little under 400 now. That's a pretty steep drop. But I saw that in 2008 with what we had in San Diego, and as well Austin. There's not as much. So we've survived that big peak and that trough. There will be a bottom sometime soon. There will be a floor where this thing will settle down. Austin overbuilt It sounds like, from what I can tell, there was just a lot more product available that people were building at the time. There was a more supply than demand. The interest rates were an impediment for people at over 6%. The average home there looked like it was up to 400 some thousand. So that was slowed the market down. And you have a lot of product out there. It naturally gets softer at that price point. There will be a place where you look at the statistics and it will finally flatten out. I don't know where that is. Yeah, none of us really do. I think we will, over a cycle of 10 years, we'll be really happy. If you bought now, that you'll be really happy by 2030. But if you bought in the peak, you're going to have to wait until 2030 to get your equity out. And you buy around now and you buy smart, you'll probably be pretty happy. Like what I spoke about, the ones that I would be going after, be very happy with your portfolio by 2030, where it's going to be in terms of value. I put a ruler on trend lines because I know trends, they swing above. We have this exuberance. I'll call it the irrational exuberance, was spoken about years and years ago around the stock market. That occurred during COVID, just irrational exuberance around there. It was nuts. And then we have capitulation, which is another great word I learned from one of my mentors. And he says, when you start seeing 5 and 6 and 10 signs on the street, people want to get rid of their property. And if you really want to go out and start picking up deals, look for those streets that have 4, 5, 10 real estate signs for sale on them, because that's where people are now in capitulation. Please take this off of my chest. I do not want property any longer. So you're not there. I don't think that's the situation. And that doesn't mean you're going to get to that full capitulation market. That's the place where smart people would buy everything. That I wish I'd bought everything that was on the market at that point in time, but I ran out of the ability. I couldn't get any more loans, so that was my problem. But there's a lot of product that's well priced right now. The values have come down a good 20%, and you can probably negotiate a further drop with some particular sellers. But it will come back. Like I said, what looked like 550 for us is now under 400,000, but it will go back up again.
That's the great thing about real estate, is time fixes all deals. And however long that is up to you, depending on how you bought, but time will fix it for sure. And on your prediction on finding the bottom, I'm in total agreement. I just don't know what's going to be the straw that breaks the camel's back on that one. I think there's a lot of people who speculate that coming into the spring of this year, when all the multifamily that was overbuilt in Austin finally gets full absorption, they get 100% leased up. We'll see an uptick in rents after that gets absorbed, because there has been no permits being filed for new builds for the next 3 years. So it's going to take at least another 3 years after that multifamily gets absorbed before there's any new inventory, that reasonable amounts of inventory that's going to affect that rent rate much at all. And then the other thought is what coming into this spring. And I think this spring is going to be very telling, whether that happens or the extra dump of inventory on the market, because that's when things turn over, is in the springtime. If that is going to create another fall, because there's so much more single family that hits the market. What will happen, and that's just what I've heard through the grapevine. I'm sure everyone else has got plenty of stories, but depending on what will happen, I think it here in the next 6 months is going to be real telling. And like you said, regardless of any of that, 2030 you'll be happy with your investment. But right now, trying to figure out where to put your money in and to have patient money to deploy it once you find an opportunity is going to be really smart.
Yeah. And none of us knows when this recession is going to happen. There will be a recession. We all know that the cycle that occurs. If it does, that's when you may see a whole lot more product come on the market, because now some people are losing their jobs. They can't afford to live in that house any longer. They want to, that's when capitulation may start to bring me in. Just watch. You don't, real estate's a long game. I've been doing it now for 35, actually, 35 years. And I learned my lesson 40 years ago when I lost money. But if you just hang with it over a long period of time, you get to go to around the world and do some tours, which is what we're doing now in our lives.
Oh, good. Peter, thank you so much for jumping on the podcast with me, taking your time to share your knowledge with everybody here. I really appreciate your 2 cents. It's worth a dime to us over here at Prime Properties. And we wish you all the best going into this Austin market. And we look forward to continue serving you. Cheers.